So it has now been 22 years since you started real estate investing. What 18 years or something like that, full time. And you saw what the market was back in 2008 market. I know I was part of the dot-com days, the dot-com bust, I should say, and that's how I got started in real estate investing. So I got to experience that real estate market going up as well. But it's interesting that you came into the market in 2007, right when the market not came in, but went full time right when the market was going down. You get to experience that growth and what you're seeing now. So share with us some of the lessons that you learned in the other market, and how is it preparing you in this market?
Yeah, it's a great question. Obviously, today's environment is not identical to what we went through back then, but there's a lot to be learned. And I think the number one thing for me that was extremely helpful watching that cycle was thinking far ahead, the concept of thinking far ahead. So one of the biggest challenges as an LP investor that I have is that I'm in illiquid deals. Like everything I'm in is illiquid. I have no public equities. And so the problem for me is that I have to think very far ahead because, as everybody I'm sure listening to this knows, as soon as I invest as an LP, first of all, I believe it's illegal for me to resell my shares within the first year due to SEC Rule 144. I'm not an attorney, so I'm not even 100% sure, nor am I a financial advisor or anything like that. And then if I want to sell my shares after the first year, I may or may not find a buyer. I probably won't get the amount that I invested. It's going to be very hard to negotiate a price. Nobody knows exactly what the asset's worth. It may be horrible timing, which would make it an even bigger discount. And so because of all that, I have to really be careful when I deploy my capital and the lack of liquidity. And what I did personally between 2005 and 2008 was sit on the sidelines. And I kept telling people, and I was much younger, I wasn't married, no kids, and I was going to dinner parties with my friends. And I tell people, look, there's going to be a housing crash. And everyone thought I was crazy. And I have to tell you, it was 4 years of agony, because for 4 years, people thought I was crazy. It's a very long time to be making that argument. It's not fun. But on the flip side, I had the reward of not having gone into anything. I didn't go into anything that foreclosed as a result of 2008. Nothing.
Wow.
Okay. I've been in one foreclosure in 2011 that was completely unrelated to 2008. That was one of those 6 dominoes fell. It was like, I could tell everybody 20 ways a deal can go bad. It's like what I call these 1% risks. It was just one of those crazy stories. But anyway, and so the reason that I managed to sidestep all of that was because of the fact that I thought way ahead. And so taking that lesson and seeing it actually work out well, and also matching well with my personality, because I have a lot of patience and I'm able to sit and wait. I've been doing the similar thing now amongst all this craziness the past few years, which we can get into if you want. But that's one of the major learnings for me. Another really interesting learning, and I'm going to have to watch out for, is that ironically, the one foreclosure I was in 2011, what I saw happen to that sponsor after that is that the next deal they had, their interest rate on their loan was higher than anything else I was seeing anywhere else. And just like you'd have a problem if you were a person buying a house and then have a foreclosure, try to buy another house, you'd have a hard time getting a loan. The sponsor was able to get a loan, but had a higher interest rate. And so for me as an investor, that meant that I had, going into a deal, I had a lower return for the same amount of risk because the interest rate was higher just because of that person's background. And so what that's helping me with today going forward is I am under the assumption from a probability perspective that it's much more probable we're going to have a recession than not coming up. And if we do, I have to be very careful, because what I have to watch out for is what's happened the last few years with floating rate bridge loans and everything else everybody here knows about that may cause some people to end up in distress or foreclosures, which will make me have to really research who I'm investing with really carefully to see if I'm dealing with someone who I'm getting a lower return with for the same amount of risk because of that same scenario or something similar. So that's another important learning that I'm going to apply coming here in the next couple of years. And anyway, so those are just a couple of quick ones coming to mind.
Wow. Okay. So what are some of the similarities are you seeing between the two markets, and for you to foresee the market's going to crash 4 years ahead of time, what I guess when did you start seeing this market might be turning? And share with us some of the differences and similarities as well.
Yeah, sure. So just getting into a little bit of economic stuff here. So let's rewind back to 2017. As of the end of 2016, I was on the sidelines except for very unique situations and pricing, because we had a very long upcycle in the economy at that point. No cycle is forever. And we started to have some indicators that stuff was really highly priced. And essentially what happened is that in 2000, I think 18, the yield curve inverted. And that was telling us that we're going to have a recession with a good amount of probability at some point. And based on my own opinion or calculations, we were probably due for that in around 2020. So in my opinion, we would have had a recession had we not had the pandemic, ironically, because there was so much money printed, it basically delayed a recession. So I was preparing for recession as of 2017 in that, again, 3 to 4 year timeline, doing the exact same thing in anticipation of it. And so once we had all the money printing in 2020, everything got crazy. High valuations got even higher. And what happens for someone like me is that I invest in something that's 80% to 100% occupied, stabilized, may or may not have any value add upside that's optional, right? So a lot of people listening to this may invest differently, but that's what I choose because I'm looking for predictable, stabilized cash flow. Well, with that in mind, I have to buy something at the right price because I'm not going into something where they're adding a ton of value. So I can't afford to buy it wrong. And so I have to be very careful. So essentially, I've been on the sidelines. I always make investments, but pretty much been on the sidelines psychologically and in terms of what I'm really open-minded to since 2020, since the pandemic money printing, when everything just went crazy. And another thing is that because of that, it prevented me from I didn't invest in any of the floating rate bridge loan deals on the apartments. And the crazy thing was, and it's just like I was going through an agonizing period between 05 and 08. And honestly, between 20 and 23, it was so agonizing because 90% plus of everything I received as a passive investor, of everything, not just even including real estate, just everything, was floating rate multifamily bridge loan deals. It was almost everything. And yet I didn't invest in any of them. But if you wanted to invest in anything, you almost had to invest in that because there was almost nothing else. And so it was just a very frustrating time. And so you're looking at someone who's been waiting a very long time for the cycle to end because now we've had a record long economic cycle. We've had crazy money, we have all these things happen, right? And now we have a record long inversion of the yield curve with the exception of 1929, also over 100 years now. And so I think we're due for quite a lot of things to happen in the next 12 to 24 months. So I've been very cautious, and that's where I think we landed today. So if you ask me, okay, what are you going to invest in today? Or what are you even considering today? The first thing I'll say is, look, let's rewind back to 2008, okay? And it's September of 2008. And just from a cycle timing perspective, let's put aside, are we in the similar economy or whatever? And so I would say, okay, it's 2008 in September. Tim, what are you going to invest in? What's a good idea right now? Knowing what you know now, right? Your answer is probably not much, right? So I'm treating it the same way because my opinion is that there's a very high probability based on a lot of economic indicators that I follow that we're going to have a recession within the next 12 months and possibly within the next 9 months. And I'm just sitting in the agonizing wait is continuing essentially. And it's not the right approach for everybody, but that's what I do. And I would say and another thing I would say is that we can go talk about some indicators, but take a look at Warren Buffett. There's a reason why he's in a record amount of cash. Right. His indicators are showing things are highly overpriced. To me, negative leverage for the past few years has been the number one indicator on the real estate side that things are overpriced and will eventually normalize. And that's if you ask me, what is the one thing that's going to get you off the sidelines eventually? It's going to be seeing the traditional positive leverage that gives me the risk reward that I would normally get as an investor that's been out of whack for a long time because of all the things we just discussed.
I see. Wow. Fascinating. So there has been a number of operators that I've interviewed on this show where for the last couple of years, they've also been stayed out, barely bought anything. And now they're starting to see deal flow now. Are you also seeing decent deal flow? Like in multifamily, as an example, from some of these operators that have been staying out and now coming back in?
Yeah. To be fair, I've seen a little bit more deal flow in the last 3 to 4 months than I'd seen probably previous. Right. And frankly, I've seen a couple deals that had it not been that they didn't meet my particular criteria, looked interesting and looked worthy of taking a good look at. But that's the first time in years I could say that, right? With the exception of the fact that I've invested personally. So one of the things I did defensively, if I didn't mention before, is as of 2017 on the multifamily side, I invested in a number of low-income housing tax credit deals. And that was a defensive play going into recession for multiple reasons. And since 2020, it's been somewhat similar, where I've invested in some of those, but also in tax-abated deals that are brand new tax-abated deals. Again, that is a defensive play going into recession and getting something at a potentially better basis than you would be getting it normally to adjust for negative leverage to an extent. So those have been some unique things that I've been able to invest in. But regular market rate, what I call a market normal deal flow, has picked up a little in the past few months. I've seen a couple that have been interesting. I'm starting to see a little bit of positive leverage, certainly in Class C stuff, a little bit in Class B. I tend to target a B plus or A minus type of, or a B or A minus type of opportunity. But one thing I don't typically invest in is something that's pre-1990s at the moment, and eventually it'll be pre-2000s. And so some of the stuff I've seen that's had that positive leverage that's been interesting has been pre-1990, 1980s, 1970s. So that's just not my fit, but I could see it being a good fit for somebody else.
I see. Okay. Let's talk about your investment thesis, right? So you mentioned that you like to diversify it among different assets, even outside of real estate, diversify among operators. Give us some insights into your investment thesis.
Sure. So I have a pretty well-defined box that I tend to target. And I'm also going to include in this definition, it's a little easier for me to describe like where I won't invest geographically versus where I will invest, because I've invested across about 43 states thus far. And I don't mean in individual assets, some funds which have had assets in multiple states sometimes. And so so let's start with what I don't invest in. So I typically don't invest in a market that is very volatile and or is very appreciation focused. So Los Angeles, San Francisco, Miami, New York, low cap rates, low cash flow, high potential increase in asset prices, not the right fit for me, right? A lot of other markets can be the right fit for me though. And depending on the asset class, I do pay attention to certain other factors. So certainly population migration, flow, outflow, inflow, and that type of thing. There are certain asset classes that are better in certain states because of ratios of, for example, mobile home parks. By the way, I'm not picking on any state, just coming randomly to mind, but mobile home parks in Alabama can be tough because single family homes are relatively low priced, and the type of revenue you want coming in from a lot on a mobile home park may not be able to sustain as well because they're up against competitive pressures of lower housing costs versus some other states, right? Similar asset class, I might invest in a mobile home park in a tornado area, but not a hurricane area. I might invest in a self-storage property though in a hurricane area. And then we can get into all the details as to why, but there are very specific things I learned over time to watch out for like that. As far as the exact box that I target, so I tend to target an A minus or B asset that's 80 to 100% occupied, stabilized, may or may not have any value at upside. Each asset class has a different sizing that I target, and it's all non-institutional. So I'm a very big fan of tenant diversification. For example, in mobile home parks, I go 75 lots or more as a strong preference, even 100 lots or more. Self-storage, I'll do a minimum 300 units and preferably over 800. Apartments, I'll do probably over 100 is my minimum. But between 100 and 400 is the most common. And then each asset class, retail, office, et cetera, has all different minimum criteria I have just for tenant diversification, because that's really important to me. So one thing I've never invested in is a single tenant triple net lease deal, which ironically would be a good fit for someone like me who wants to flip a coupon, but I can't handle like you're either 100% occupied or 0% occupied. That just doesn't work well for me. Because my whole philosophy is I want to go to sleep tonight, wake up tomorrow, and not much has changed because I live off the cash flow. If I'm investing in a 200 unit apartment building and one person leaves, and now it's instead of having 190 tenants, you have 189, that's okay. And so my cash flow will still probably come. And so those are the type of things I tend to target. And we can get into more details if you want, just trying to keep it high level.